consideration of the committee. The MPC noted with satisfaction the fourth consecutive quarters of growth in real GDP and the positive growth outlook in the domestic economy. This is shown by the sustained improvement in the manufacturing and non-manufacturing purchasing managers indices in the second quarter of the year. The MPC commended the approval of the 2018 federal government budget and called for an accelerated implementation to further support the fragile growth recovery. Committee also called for sustained implementation of the Economic Recovery and Growth Plan, ERGP, to further stimulate output growth. MPC was, however, concerned about the liquidity impact of the 2018 expansionary fiscal budget and increasing FAC distributions due to rising prices of crude oil, as well as the build-up in election-related activities. Notwithstanding the positive direction of the outlook, the MPC reviewed the effects of the sustained monetary policy normalization in some advanced economies, with implications for capital flow reversals, exchange rate, and domestic price pressures, as well as other challenges to growth during the second half of 2018. The committee took note of the sustained moderation in inflation pressure, especially the headline inflation, as well as stability in the foreign exchange market, but expressed concern on the threat posed by the incessant herders and farmers' crisis in some key food-producing states, the negative impact on food supply chains, which would continue to exert upward pressure on food prices. The committee therefore called on the bank to continue to build on the progress already made in arresting the trend to sustain the moderation in inflation. The MPC also observed, with satisfaction, the high level of activities in investors and exporters window of the foreign exchange market, which continue to supply liquidity in the foreign exchange market, narrow exchange rate premium, and reduce speculative activities in the market. The MPC noted the continued improvement in the performance of deposit money banks and expressed optimism that the moderation in the levels of non-performing loans in the industry would continue. The committee therefore called on the federal government to accelerate the settlement of outstanding contractor debts and also encourage the bank to ensure strict compliance with regulatory provisions. In discussing the economic report presented to the members, it was observed that as the prices of crude oil prices in 2017 and 2018, the monthly allocation to various levels of government also increased, suggesting that federal government was not conscious of saving for the rainy day. The committee therefore advised the fiscal authorities to build buffers, especially now that the price of crude oil is relatively high. Committee's consideration. Informed by the developments in the global and domestic economic financial environment, the committee painstakingly reviewed the policy options available. In particular, committee considered the sustained positive growth in the real gross domestic product over the last quarter, stability in the foreign exchange market, high level of accretion to external reserves, as well as the deflationary trend. The MPC deliberated on the rise in food inflation, impact of the expected liquidity from the expansionary 2018 federal government budget, and rising FAC disbursements in the second half of the year, along with the buildup of pre-election spending. The committee strongly considered the option of tightening, believing that tightening would curtail the threat of a rise in inflation, even as the injection from the fiscal authority will still provide the economy with substantial liquidity. Notwithstanding the deceleration in inflation, in headline inflation, the current double-digit inflation rate remains above the bank's 6 to 9% target range. In addition, the committee is of the view that tightening will help stem the tide of capital flow reversals in the face of sustained monetary policy normalization in some advanced economies. This, the committee believed, would rein in inflationary pressure and moderate inflation rate to single-digit levels, increase real interest rate, build investor confidence with attendant positive impact on capital inflows, and further stabilize the country's exchange rate. On the contrary, the committee is of the view that raising interest rates at this time would weaken consumption and raise the cost of borrowing to investors in the domestic economy. In addition, the policy would trigger repricing of financial assets by deposit money banks and further constricting to the real sector that would promote a non-inclusive growth without development. In considering the option of loosening, the committee assessed the potential effect of stimulating aggregate demand through lower cost of capital. This could stimulate consumption and aggregate demand. Committee, however, considered its potential relevance, taking into account the expected liquidity injection from the 2018 budget, increased FAT disbursements, and election-related spending ahead of 2019 general elections. If this crystallizes, it will exacerbate inflationary and exchange rate pressures, as well as return real interest rate into negative trajectory. Moreover, lowering policy rates may not translate to an automatic reduction in market rates due to poor transmission mechanism owing to structural rigidities. The committee is also of the view that loosening could reverse the gains already made with reduced importation, which has strengthened the current account balance. It will also lower banks' risk appetite and possible rise in NPLs, which could negatively impact on the banking industry stability. In the discussion for a hold, it was noted that risks to the macroeconomic and financial environment appears fairly balanced, with improvements in output growth and inflation. Holding policy at the current stance will support growth and further moderate inflation. However, committee noted the appetite of the public for loosening and concerned that holding MPR at 14% since July 2016 and considering the dynamic nature of the market, the rate might have lost its signaling effect on the market, hence dampened market expectations. The argument in favor of maintaining the current policy stance is to monitor the magnitude of the liquidity impact of the fiscal injections and election-related expenditure ahead of the 2019 general election. Overall, Monetary Policy Committee was of the opinion that while it is difficult to encourage job creation in an environment with deficit in infrastructure, the committee believes that the bank should continue to encourage deposit money banks to increase the flow of credit to the real economy to consolidate economic recovery. In this regard, the committee believed that a heterodox approach to reform the market to strengthen the flow of credit would be appropriate at this time. Consequently, credit-constrained businesses, particularly the large corporates, are encouraged to issue commercial papers to meet their credit needs at low interest rates and possibly single-digit rates, and the CBN may, if need be, buy those instruments to complement the efforts of the deposit money banks. In addition, as a way of incentivizing deposit money banks to increase lending to the manufacturing sector and the agri sector, a differentiated dynamic cash reserve requirement regime will be implemented to direct cheap long-term bank credit at 9% with a minimum tenure of 7 years and 2 years moratorium to the employment elastic sectors of the Nigerian economy. Details of this framework are being worked out by the Banking Supervision and the Monetary Policy Department and Research and will be released very soon. In consideration of the foregoing, therefore, the committee decided by a vote of 7 members to retain the monetary policy rate at 14% alongside all other policy parameters. 2 members, however, voted to increase the MPR by 50 basis points, while 1 member voted to increase the MPR by 25 basis points. Consequently, the MPC voted to retain 1, the MPR at 14%, 2, CRR at 22.5%, 3, liquidity ratio at 30%, 4, asymmetric corridor at plus 200 and minus 500 basis points around the MPR.